Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City, and I am here to bring you the market wrap up for the week ending August 4th, 2023, that began on July 31st. What we're looking at here is a chart of the three major market indexes: the Russell 2000, the Nasdaq 100, and of course the S&P 500. What we were doing is we're measuring the percent change in performance from the close of the prior week, the prior Friday, which of course was the 21st of July. So here are here's the market action for the week, and so we can see the market had took a breather after a number of bullish, basically being in a bullish phase. Last week was certainly a breather. We can see that the Nasdaq was down about 3%, the S&P was down about 2%, and the Russell was down about 1%. But in fact, that breather, in a sense, was probably more created by a kind of a punch, which was Fitch, the credit rating agency, for some reason last week decided that U.S. Internal politics is kind of toxic for getting things done, and might be potentially injurious to the economy. And all of a sudden, they woke up last week on Wednesday and it decided to downgrade our credit rating, the U.S. credit rating, from a AAA to AA plus. Why they chose last week is kind of funny, because we went through that whole debt ceiling brinksmanship 2 months ago. But I guess they took them about 2 months to figure out that maybe our politics doesn't work all that well. But all of a sudden last week, they woke up and decided to downgrade our debt. So at any rate, you can see the evidence of that right here. Here was the on August 1st, here was the close during the beginning of the week. And then this is the second. This is the day that they actually announced it. Okay, so we can see in the very beginning of the week, we had actually started out somewhat auspiciously. We were actually up about 1%, 0.5% or so, at least on the Russell, and the S&P was kind of even. But then once they announced that, that kind of took it down a couple of percentage points. So that was what kind of went on last week. The other thing to point out here is this is the TLT. This is the 20-year bonds, and this is actually something I showed in the last video, what I've been talking to our subscribers about. So here is the Russell the TLT, the 20-year notes here, and that was also down about a little over 3%. And this is actually something that I had shown our subscribers, as well as I think I had done in the last video last week. But let me just reiterate this and kind of show this to you again here, because it's actually kind of really useful. For years, there was a sort of a traditional relationship with the bonds and the equity markets, and there was kind of a reliable inverse correlation. In other words, the S&P and the other equity indexes, if they went up, generally the bonds went down, and vice versa. And in fact, if you looked at, let's say, for the last 60 days, and this is a great chart here, this is the MRCI More Research website, and they actually have this nice correlation grid here. And if we look here for the last 60 days, we can see here's the S&P, and then right here is the TY, which is the 10-year note. So it's not the 20-year note, but they're all going to be moving in the same general way. We can see I had a minus 83 correlation. In other words, 83% of the time for the last 60 trading days, if the S&P was up, the 10-year note was down. Okay, and so that's a very, kind of a pretty reliable 4 out of 5 inverse correlation. But if we go to the last 30 days, okay, last 30 trading days, which of course is the last, more or less the last 6 calendar weeks, and if we go to that, we notice that number that was just minus 87 is now minus 20. Essentially, that inverse correlation is kind of extremely weak. Okay, and if we go back, let's say 180 days, which would be about 7.5 or 8 months on the calendar. These are all trading days, of course. Okay, we can then see that correlation was around minus 50. Okay, so and that's generally, it's always been kind of 50, 60, 70. Okay, but again, last 60 days, okay, it got really strong, and then again for the last 30 again, and now it's only minus 20. So essentially the correlation is not, particularly for the last 60 days, has really been kind of all over the place. It's been very strong. Now it's kind of very weakly inverse, and at the point where a correlation is kind of all over the place, it's really not a correlation anymore if you think about it. So at this point, we really don't rely on that anymore. But at some point, that might come back. But meanwhile, again, I just wanted to point out that it's not all that surprising now to see the bonds and the equity indexes actually moving in lockstep, which was never the case up to the point where lots of sort of intrusive monetary policy and quantitative easing went on during the financial crisis and all that kind of stuff. So this has been breaking down, particularly for the last few years, and then of course we just saw some very strong evidence of this even in the last month. So I figured I would just point that out. All right, so let's go look at some trading levels on these on the equity indexes. Before I do that, though, of course, the ubiquitous disclaimer: Precision Trading Labs, we are not financial advisors or fiduciaries or broker dealers, but we are simply providing you, hopefully, with good, actionable trading information and education to help you become confident traders. All right, so let's take a look at the charts here. And so right here, we're looking at the SPY. Okay, so we're looking at the S&P 500. This happens to be a 2-hour chart, but we're generally kind of looking at this in the context of the daily chart, and then here and there, I will flip this to the 2-hour chart just to kind of give a little more detail. Okay, so right over here, we can see in the middle of July here, we had this level where there was a gap up, a consolidation, and then another gap, and then kind of price went from there, and really kind of almost with this one little pause, kind of a string of green candles here, many of which were actually kind of bullish candles. Okay, so now prices returned to this region that I highlighted here. This is the potential area for a bounce. Now, I'm not suggesting here that we were actually going to get a bounce from here, because we still may have the hangover from the consolidation, the downgrade. So we'll be watching this, but quite often from here we would actually get a bounce. So why would we get a bounce? Okay, because this is an area of demand. This is an area, and I have this note here. It's an area of upward price pressure, expected upward price pressure, where we have an area of consolidation, and then right here, this is where supply and demand were basically in phase, in agreement. Okay, buyers and sellers were essentially willing and had the same perception of price, and so shares were getting kind of shuffled back and forth within this region. But then right here, that agreement got broken, and essentially there was an exhaustion of sellers here. Okay, the sellers just disappeared. And the reason that these trades happened, of course, is that buyers essentially ran up the price chart until they could find willing sellers. And that's, of course, what created the rise in price. Okay, so because price was in here only a very brief amount of time, the theory is not everybody that necessarily wanted to buy here got the opportunity to do so, because it was only in here for a brief period of time. And so there is potentially likely still demand still in here. So when price returns to the region, it's quite possible that we can get another bounce here. But we will kind of keep an eye on that on Sunday when the futures open at 6 p.m. Eastern time. That's when the futures market opens, and we'll kind of take a look at what does the S&P look like when the futures market opens, and at that point we'll have an indication as to whether we might actually see a bounce from here, or essentially we still have a hangover from last week, and price continues to drive through and kind of violates this level. Okay, so we'll have a good indication of what's going to go on tonight. All right, or I should say on Sunday night. Okay, so that's where we are now. But if this would happen to break, then the next quality level is really down here, and that's about 7 S&P points down, which is equivalent from the Friday's close of about 1.5%. Okay, and if I turn this into very quickly here, if I turn this into the daily chart. Okay, so here's the level of what we were just looking at here, and this is what we refer to as a drop, a base, and a rally here. price dropped here, consolidated, and then kind of rallied up in the daily chart here. And again, there's that same point that I made before. Price is in here a relatively brief amount of time. Okay, notice that the closes were in a relatively narrow range here, from there to there to there, and then after that, price rockets out of there. Okay, and again, that the exhaustion of sellers essentially happens right here. Okay, so that's where the levels are in terms of the SPY. And if we go back here to the 2-hour chart, here's where we are. Again, if we look above, okay, this would be an area of supply up here, okay, and an area of supply where price rallies up, goes sideways, consolidates, and then notice a gap and a drop. It's the exact same scenario as what I described for demand, except of course on its head. So this is an area of an anticipated future downward price pressure, and that's created by an exhaustion of buyers here. Okay, the buyers and sellers were in agreement here, supply and demand were in agreement, and then price dropped out of here. Okay, so the point being is that if price returns to the level, under certain circumstances, I would expect to see a drop from here. I actually don't expect to see that here, though, and that's because if we go back in time and we take a look, we go back in time here, we can see that, in fact, this was already an area of supply once price came back to it a second time. Okay, so there was that first return to this supply region, excuse me, and now it's been back here 3 times. So when something is back here 3 times, we don't necessarily expect that it's going to continue to work like this. This is more almost like a triple top than a supply zone at this point. So at that point, I would not necessarily expect price to hold this region to hold price down. So I'm really not looking to short up here. So in fact, the next really clean areas of supply are actually sitting kind of up here. And right there, you can see the price came up here, peaked, dropped with a great deal of energy. Okay, and price has not been back there since. Okay, so that's really the next clean area where I would expect that I'd really be looking to short, and that's of course that's a fair distance above. So we'll see what happens here, though. But in terms of the nearest kind of nice trading opportunity, I think this would be it to actually for a long trade, and that's about 1.5% down. On the other hand, on Sunday night, okay, price could respond to this area, and at which point then we could actually be looking for a bounce out of here. Okay, so we'll see what the futures bring when they open Sunday night. All right, so that's the SPY. Let's take a look at the Qs. Okay, so right here you can see right here, this is more or less the same level as what I just showed you in the SPY. Okay, so price has actually been back here once, sort of tried to bounce out of here, is now back in here again. And again, this is more or less the same level of the SPY. And that's the other reason why I'm really not too sanguine that we're going to get a bounce from here on the SPY either. Because, okay, you can see the Qs, it kind of tried, on Thursday, I think, or Wednesday or Thursday after that Fitch downgrade. But really, there was an aborted attempt at a bounce, and now you can see it just came right back. So I'm really not expecting this to hold. And frankly, if this doesn't really hold, it's very unlikely that the SPY is going to hold either. Okay, so at that point, then that's why I'm really thinking that the quality level right here and that other quality level that I showed you in the SPY is more or less kind of similar to this, although a little closer. This is the level on the Nasdaq 100 index that I would expect to see a potential bounce. And you can see from Friday's close to the distance there, that's about 12 QQQ points down, and that's a little over 3% down. From in terms of a percentage move. Okay, if we go back, if we look above, again, this is similar to what I just showed you in the SPY on the Qs, where essentially we have a level that was already tested here. Okay, so right here was that rally, a base, and a drop here. Okay, In other words, this was an area of supply where we had an exhaustion of buyers here. Okay, price came out of here with a great deal of energy, was in here only a very brief amount of time, and so there's the expectation that when price returned to here, we would then get another push down. And in fact, if we go back now to where we were, and this was in the middle of July, we can see that's exactly what happened. Price came up here and then pushed down from here. Okay, so now when price comes back here again, we'll keep an eye on this level, but this is now a lower probability trade because essentially some of the supply has already been chewed up from this first return, this first retracement back to that supply zone. But we will certainly keep an eye on that. And the other thing that could happen though is right in here, and we will certainly keep an eye on this before it actually gets to that level. Okay, notice price came up, rallied into here, consolidated, and then gapped and then dropped kind of, with a great deal of energy. Oftentimes when you're in between major levels, the area within this tends to be kind of choppy trading and less reliable. But having said that, this is an area of supply, but in fact, again, I'm a little hesitant about it because it's sitting between kind of two clean levels, and here's one level that really cleanly worked already. Here's one where we're waiting for it to work. So oftentimes these where there's a lot of trading in between, they tend not to be great levels. But we'll certainly keep an eye on it, and this could be an area where we could actually get, price could get smacked down from there. So the distance from where we are to from where we currently are to here is, if we pull that up here, we can see that this is about 2.5% up at about 9 or 10 points up on the Qs. Okay, so that's where we are from there. And if we go to the Russell 2000, okay, here's where we are in the Russell 2000. So right here we have this drop, a base, and a rally there. Okay, right here price has now come down here. We can see that this has been a little area of support here. Okay, notice price kind of these wicks comes down, comes back again, wicks up. Okay, so this is kind of a weak area of support. I wouldn't necessarily expect this to hold at all, and really what I'm expecting is to see this kind of come down to this level and potentially to sort of get a bounce out of there. All right, so that's where we are on the Russell 2000. And then if we go back right here, here's the 52-week high on the Russell. Okay, that blue line there. So if we go back now, okay, and we go right to here, okay, right here, here's that rally base, and then notice that string of very energetic, very bearish candles that kind of come out of there. And so that's really an area where we would expect to see kind of a downward price move. Okay, so this is an area for potentially for a bounce, which is about 1% down. And then if I'm looking up here, okay, this is about 4% up. So there's nothing I'm really looking to immediately short on the Russell. I mean, that's certainly the quality level. Right in here, there is something. Okay, and if we blow this up just a little bit here, we can see, okay, price drops here, and then notice then we have this gap. Okay, it kind of pulled back a little, and then from there kind of went down. So this would be an area potentially for maybe some kind of scalp trade for a bullish scalp trade. But I really would not be looking at this for really any sort of prolonged bearish move. This would be kind of an intraday trade probably. So if we look in terms of where that is in relation to where we currently are, that's a short distance away, and that's about 1.5% from the close on Friday. So those are kind of the near-term levels. So right here, this is a quality demand zone. There's quality supply up here, but that's about 4% up or so. So those are the levels that we're looking at on the Russell 2000. So at any rate, there you go. There is our market recap. So that concludes our market recap for the week. Hope you found this useful. Hope you found it helpful. If you did, please go to our YouTube page, give us a like, subscribe to our channel. Also, if you go to this link that you'll see in the YouTube entry, you can schedule a call. I'd be happy to talk to you about the whole supply and demand concept, how we use that, talk about how we create setups out of that, and be delighted to talk to you. So anyway, that is it. This is Mitch Firestone from Precision Trading Labs, and I will see you next time. Thank you.